Hi, everybody. It's Jessica Stone at Stansberry Research. I'm joined now by Scott Garliss, the editor of Stansberry Newswire. And Scott, you've been writing about summertime and stocks, and your advice is don't get out of stocks this summer. What's going on there?
Well, so the financial media, if you listen to them, a lot of people like to push this phrase called, they say sell in May and come back in September. And I think what they're really doing is giving people bad advice. And so if you do that, you're going to miss out on some of the best gains of the year.
Because those happen while I'm on the beach drinking a pina colada?
Pretty much.
Assuming I actually got to do that this summer?
Because while you're on the beach drinking a pina colada, so are all these other traders at these big hedge funds. So these guys aren't paying as much attention to what's going on. They're trying to spend time with their families. And because they're not paying attention, they're not reacting as much to the news. So they're sort of leaving things alone, and stocks tend to perform better in those time frames. If you look at this chart I have, in July, you get the best gains of any month of the year. The average return since 1928 is 1.6%. Conversely, in September, you have the worst month out of the calendar year. The average loss since in that same time frame is a loss of 1%. But also, what I would point out is this 3-month time frame of June, July, and August in terms of the calendar year. That's the best 3-month window of the year. The average gain is 3% during that time period.
So a really bad time to take your money out of the market. So even if I go on vacation, my money should not. One thing that struck me about this is that this year we saw a second quarter with like negative growth in some cases, right? So it seems like it's even more important for us to stay in the stock market and benefit from the recovery because we saw such a loss in the second quarter.
Yeah, and what I would argue right now to that point is the fact that if you've stayed in it this long and you've ridden this rebound, you have been through the worst of it in terms of economic growth. I mean, the number of Fed guys are telling us we're going to see contraction of 35 to 40% in the second quarter. It's going to be possibly the worst all time. But then after that, in the third and fourth quarter, we're going to see what might be the greatest rebound we've ever seen in that country. And it would really be a shame to have ridden it out for that and then miss out on what's going to happen on the other side.
So I want to pick up on something you said earlier. You said something like September is a really bad month, but I'm wondering if that timeline's going to shift this year because of what we're talking about. And I'm also wondering how to take advantage of the losses in September. Is that the best time to get in, for example?
That's an excellent point as well. Yes. I mean, again, what we really want to do is be long-term investors, right? And we want to ride out the entire storm and realize that they're going to be bumps and they're going to be ups and downs, basically. But if you were looking for a time to get in and you were thinking about what's the best time of the year, September probably offers one of the best times to get in because the returns from there get much better. The fourth quarter usually has good returns as well.
So now can I start singing "See You in September"? I'm sorry, there's just so many songs with this segment. And plus, I really like the idea of getting to be on a beach drinking a pina colada. But in any case, Scott, we thank you as always for having a few extra tips up your sleeve for investors. And if those of you watching would like to see more of this type of content, please subscribe to our YouTube channel. You can also find us on Facebook, Instagram, LinkedIn, and Twitter. Thanks for watching. That's all for now.